When most people hear the word stocks, they imagine something complicated, risky, or only for rich people in suits. But in reality, stocks are one of the simplest financial concepts that exist. A stock is nothing more than a small piece of ownership in a company. When you buy a stock, you are literally becoming a partial owner of that business. It doesn't matter if it's a massive company like Apple or a smaller one you've never heard of. You are buying a claim on its future. You are betting that the company will grow, earn more money over time, and become more valuable. Companies sell stocks for one main reason. They need money to grow. Maybe they want to expand into new markets, hire more employees, build new products, or pay off debts. Instead of borrowing money from banks, they can raise capital by selling pieces of ownership to the public. This first moment when a company offers its shares is called an initial public offering, or IPO. After that, those shares can be freely traded on the stock market between investors without the company being directly involved anymore. And from that point on, the stock's price becomes a reflection of expectations, not just what the company is worth today, but what people believe it will be worth in the future. If investors believe the company will grow and make more profits, the price goes up. If they believe the company will struggle, lose relevance, or face problems, the price goes down. In many ways, stock prices are driven more by psychology than by logic. There are different types of stocks, and understanding them helps you avoid making emotional decisions. The most common type is common stock. This is what most people own when they invest. Common stock usually gives you voting rights in shareholder meetings and the possibility of receiving dividends, which are payments the company makes to shareholders using part of its profits. You don't get guaranteed income, but you get a voice and potential upside. Then there is preferred stock. These stocks are different. Preferred shareholders usually don't have voting rights, but they receive dividends before common shareholders. If a company runs into serious financial trouble or even goes bankrupt, preferred shareholders also get paid before common shareholders. So in exchange for giving up control, they get more stability. Beyond these basic categories, there are behavioral types of stocks that reflect different growth strategies. Growth stocks are companies that are expanding faster than the average market, that usually reinvest all their profits into growth, which means they rarely pay dividends. Investors buy them because they believe the company will be much bigger in the future. Most tech companies fall into this category. They are risky, volatile, but potentially very rewarding. Income stocks are almost the opposite. These companies are usually older, stable, and already established. Instead of reinvesting everything, they distribute a portion of their profits to shareholders regularly. People invest in them not for excitement, but for predictable income. Utility companies, banks, and large corporations often fall into this category. Then there are value stocks. These are companies that appear cheap compared to their fundamentals. Their price-to-earnings ratio is low, meaning the stock is inexpensive relative to how much profit the company makes. Sometimes this happens because the company is temporarily unpopular or misunderstood. Value investors believe the market has overreacted and that the stock will eventually recover. In other words, they try to buy fear and sell optimism. Finally, there are blue-chip stocks. These are the giants. Well-known companies with long histories, strong brands, and consistent growth. They're considered safer not because they can't fail, but because they have already survived multiple economic cycles. Investors buy them for stability, dividends, and long-term reliability. The reason people invest in stocks is simple. They want their money to work for them. The main benefit is capital appreciation, which means the stock becomes more valuable over time. You buy low, sell higher, and keep the difference. Another benefit is income through dividends. Some investors build entire portfolios designed to generate monthly or yearly cash flow. There's also a tax advantage in many countries where long-term investments are taxed less than short-term profits or regular income. But stocks are not magic. They come with real risks. A stock can lose value, sometimes slowly, sometimes very fast. In extreme cases, a company can go bankrupt and your investment can go to zero. And even when companies survive, stock prices fluctuate constantly. Your portfolio will go up and down. Dividends can be cut. Nothing is guaranteed. This is where psychology becomes more important than intelligence. Most people lose money in stocks not because they don't understand numbers, but because they panic, overreact, chase trends, or sell at the worst possible time. The biggest enemy of investors is not the market, it's their own emotions. Buying stocks today is easier than ever. You can buy directly from companies through special plans, although this is less common. You can reinvest dividends automatically, allowing your money to compound without effort. Most people use brokers, either discount platforms or full-service advisors, to buy and sell shares. And instead of choosing individual stocks, many people invest through stock funds, which spread your money across many companies at once, reducing risk. But regardless of how you invest, one rule never changes: research matters. Before buying anything, you need to understand what you are buying. Annual reports show you how a company actually performs. Prospectuses explain risks. Stock reports analyze financial health. And licensed professionals exist for a reason, because financial markets are full of misinformation and manipulation. The real danger is not losing money once. The real danger is never starting because you feel overwhelmed, confused, or afraid. Most people delay investing for years because they believe they need to be experts first. But the truth is, the biggest advantage in investing is not knowledge, it's time. Time allows mistakes to be corrected. Time smooths volatility. Time compounds small decisions into massive outcomes. And this is where most people fail. They wait for perfect conditions that never arrive. They try to avoid all risk and end up avoiding all growth. They keep their money idle while inflation slowly destroys its value. They overthink, hesitate, and stay stuck in financial paralysis. In the end, stocks are not about becoming rich overnight. They are about participating in the global economy instead of just watching it from the sidelines. They are about shifting from being a consumer to being an owner, from depending on salaries to building assets, from reacting emotionally to thinking strategically. And that shift is not financial, it's psychological.
If you made it this far, you're already different. Most people say they want to invest. Most people say they want financial freedom. But very few are willing to slow down and actually understand what they're doing. That's why most people lose money. Not because they're unlucky, not because the market is rigged, but because they invest with emotion instead of education. They chase hype, they follow trends, they panic when prices drop, and they celebrate too early when prices rise. If you're here, it means you don't want to gamble. You want to think, you want to understand, you want to build wealth the right way. And that already puts you ahead of the majority. But here's the truth. Watching one investing video won't change your life. Understanding money is not a one-time event. It's a shift in identity. It's deciding that you're no longer a consumer of trends, but a builder of assets. That's what this channel is about. Money behavior isn't about get rich quick. It's about understanding risk, understanding psychology, understanding leverage, understanding how your behavior affects your bank account. Because investing isn't just numbers. It's discipline, it's patience, it's emotional control. And those are skills most people never train. If you want to become someone who invests with clarity instead of fear, who builds long-term wealth instead of chasing fast money, who understands the system instead of being used by it, then this is your environment. Subscribe, not because you liked this video, but because you're serious about changing how you think about money. Comment below, are you investing already or are you just starting? And if you're just starting, say beginner. I read the comments. I build future videos around your level. This channel grows with people who want to grow. If you're here for hype, this isn't for you. If you're here to build intelligence, discipline, and real wealth, welcome to Money Behavior.